Empire Earnings. Build your financial empire.
When prices at the grocery store spike month after month, the immediate result is the erosion of everyday purchasing power. The opposite extreme is a recession, where a sudden freeze in business investment can trigger widespread job losses that ripple through entire communities. Because these downward or upward spirals can become self-reinforcing, they often require external intervention to prevent a temporary downturn from becoming a long-term crisis. To manage these cycles, modern economies rely on two distinct mechanisms: fiscal policy and monetary policy. Understanding who controls these tools and how they are deployed is the first step in decoding the headlines during times of economic volatility. Fiscal policy is managed exclusively by elected government officials, specifically the President and the members of Congress who oversee the national budget. This chart shows how the strategy is built on two specific pillars: government spending and tax policy. To manage these cycles, modern economies rely on two distinct mechanisms: fiscal policy and monetary policy. Understanding who controls these tools and how they are deployed is the first step in decoding the headlines during times of economic volatility. Fiscal policy is managed exclusively by elected government officials, specifically the President and the members of Congress who oversee the national budget. This chart shows how the strategy is built on two specific pillars: government spending and tax policy. During a recession, lawmakers use these tools to increase demand, dropping tax rates to leave more cash in private hands while increasing federal spending to stimulate activity. These individual income tax returns are the primary mechanism for that adjustment, determining how much of a household's earnings are redirected into the federal budget. To combat inflation, the government reverses this process, raising taxes and cutting spending to deliberately reduce the amount of money circulating in an overheated economy. This makes fiscal policy a direct method of using the government's own balance sheet to either inject capital into the economy or extract it. Monetary policy operates differently, as it is controlled by unelected central bankers. In the United States, this is the responsibility of the Federal Reserve. Members of the Board of Governors are appointed to long terms, giving them the independence to make technical adjustments to the economy without the immediate pressure of an election cycle. Instead of debating tax laws, these officials focus on the money supply, managing the actual volume of currency circulating through the financial system. This model shows their two primary dials: adjusting interest rates and changing reserve requirements, dictating how much cash banks keep on hand. The Fed's dual mandate requires keeping this scale balanced, using these dials to pursue maximum employment without allowing dangerous inflation. We see this in action when a central bank raises interest rates, making it more expensive for businesses and consumers to borrow, helping curb inflation. While fiscal policy relies on the budget, monetary policy steers the economy by manipulating the underlying cost and availability of money itself. Side by side, the distinctions become clear. Fiscal policy is the domain of the elected government, while monetary policy is the work of an independent central bank. The tools are distinct: taxes and spending on one side, interest rates and reserves on the other. Stable growth is rarely the result of a single action. It requires both institutions to pull their respective levers in coordination to address shifting economic conditions. This framework clarifies the news, identifying tax debates as fiscal interventions and rate changes as monetary ones. Identifying these mechanics makes it possible to look past political rhetoric and understand how a nation actually manages an economic crisis. An economic collapse is a systemic failure. A crash in one sector triggers a cascading loss that impacts every level of society, from industrial logistics to individual household budgets. Economists track the weight of this system through aggregate demand. This is the absolute sum of all spending on goods and services within an economy over a specific period. Macroeconomics quantifies this total output as a rigid mathematical equation, a structure with specific, measurable dimensions. That total output structure breaks down into four specific components: aggregate demand equals C plus I plus G plus the value of X minus M. A functioning economy requires these four distinct variables to maintain a volumetric balance. When these volumes are aligned, national employment holds steady and prices remain predictable. But if an economic shock hits, a sudden drop in consumer confidence, or a global supply chain freeze, individual spending categories can contract, pulling the support out from under the entire system. To prevent that loss of support from turning into a total collapse, governments utilize fiscal policy. Fiscal policy is the practice of managing the government's budget and adjusting tax rates to intentionally alter the volume of the aggregate demand equation. Because a government cannot directly force private citizens or corporations to spend their cash, lawmakers must target the variables they actually control to offset the ones they cannot. This framework allows the government to treat the economy as an adjustable system, where targeting specific variables can compensate for instability in others. Looking at this isolated block, we start the breakdown with the largest component of the formula, C. C represents consumer spending on everyday goods and services. This tracks everything from household groceries to healthcare and rent. Because it relies on the daily economic activity of the entire population, it makes up the bulk of aggregate demand. It is also highly volatile, reacting instantly to public panic or widespread job losses. The next variable in the mathematical structure tracks the business sector. I stands for investment spending on business capital goods. This measures corporate expenditures on tangible assets like new factories, heavy machinery, and software systems. This investment category reacts sharply and preemptively. If corporate boards anticipate a drop in consumer spending, they often freeze capital investments before a recession officially begins. The formula also accounts for money moving across borders, represented by this final private sector block. This is net exports, calculated by taking total exports, marked as X, and subtracting total imports, marked as M. Consumer behavior, corporate investment, and international trade are driven by unpredictable market forces. This leaves the overall volume of aggregate demand vulnerable to rapid, uncontrolled contractions. To protect the system against that vulnerability, the equation requires a structural counterweight. Here we see the G variable, which stands for government spending on public goods and services. While C and I are driven by the unpredictable impulses of the market, the volume of G is dictated by deliberate policy decisions. The strategy of utilizing this specific variable to manage national economies was formalized by British economist John Maynard Keynes. Conventional thought once suggested markets would naturally correct themselves over time. Keynesian economics argued that governments must actively manage stability to prevent prolonged downturns. The core theory states that when private sector crashes cause a negative shift in aggregate demand, the state must increase its own spending to offset that loss. By manipulating this government expenditure element, along with adjusting tax rates to influence private income, lawmakers established the foundation of modern fiscal policy. Keynesian theory transformed government spending into an active, strategic lever designed for economic rescue. When an unemployment shock hits, the recession immediately targets the private side of the equation. As citizens lose their jobs and corporations halt expansion, the volumes of C and I shrink, destabilizing the total aggregate demand structure. To correct this specific imbalance, a government enacts expansionary fiscal policy. The response is to increase the volume of the G variable to fill the void left by the private sector. This expansion typically targets infrastructure projects, education initiatives, and unemployment benefits. Injecting capital into these areas replaces the missing demand, stabilizing employment in those sectors while the broader market recovers. The formula is equally useful for diagnosing an economy growing too fast. If capital floods a market too quickly, it drives rapid inflation and creates precarious asset bubbles. In this scenario, the volumes of consumption and investment blunt the total output past a sustainable equilibrium. The required mathematical cure for this excess heat is contractionary fiscal policy. Government spending is deliberately reduced and sovereign debt is paid down, pulling volume out of the formula to correct the overexpansion. Fiscal policy functions as an asymmetrical shock absorber, moving in the opposite direction of the private market to enforce stability. Adjusting these spending levels ultimately operates as a mechanism of network stabilization. This gear assembly demonstrates the difference between the direct targets of a fiscal policy and the indirect consequences it generates. A government exclusively applies force to the central expenditure element, the G gear. They fund a new highway or expand a state budget. Turning that central gear mechanically forces the consumption and investment gears to respond. By employing government workers or contracting construction firms, the state provides direct paychecks. Those citizens use that income to buy groceries and pay rent, preventing a collapse in national consumption. The same mechanical transfer applies to the investment element. During a recession, extended unemployment benefits replace lost income. This allows individuals to maintain personal consumption, which signals to corporations that demand will not drop to zero. Stabilizing the national economy relies on this mechanical transfer, using a single public lever to generate the necessary momentum across the entire private sector. Think about every dollar spent, borrowed, and consumed across the country today. Economists bundle that grand total into a single metric called aggregate demand. When you look at a number that massive, it feels like an organic force of nature. But is this total sum just a random outcome of millions of independent choices, or is someone deliberately steering it? A central authority exerts massive influence over that total demand by controlling one foundational element, the physical and digital supply of money. By tracking exactly who has the authority to manipulate this money supply, we can finally understand why our daily economic reality constantly fluctuates. Before we can map how this works, we need to draw a strict line between two completely different authorities trying to control the economy. First, there is the government. Their exclusive domain is called Fiscal Policy, which they manage entirely through federal spending and legislation. This is the mechanism they use to directly extract or inject money into the system through taxation. Separate from the government is the central bank. Their domain is monetary policy, a toolkit used exclusively to manipulate interest rates and the money supply. So, to figure out how sweeping economic shifts actually occur, we're going to mute the government's fiscal policy entirely and solely track the central bank's monetary chain reaction. Scenario 1. The economy is currently suffering from sluggish growth. To fix it, the central bank initiates what is called expansionary policy. They reach into their toolkit and pull three initial levers. They buy up treasury notes, lower the interest rates on bank loans, and reduce the reserve requirements. The mathematical result is immediate. Pulling these levers forces a sudden, massive injection of new money into the total supply. And here is the critical rule. Money supply and interest rates share an inverse relationship. When the supply expands, the cost to borrow that money goes down. Artificially lowered interest rates act like a green light. They create immediate, irresistible incentives for banks to approve loans and for businesses to take on cheap debt. This trickles down instantly. Businesses use that cheap debt to expand and hire, meaning more people have paychecks. Suddenly, spending that money feels incredibly attractive relative to locking it away in savings. This expansion also triggers a rise in inflation. As local prices shift, domestic products become relatively cheaper for consumers in other economies, providing a strategic advantage to exporters looking to sell abroad. Looking at the full sequence mapped out on this flowchart, the strategy is clear. By tipping that first domino, the central bank successfully engineers a massive increase in total aggregate demand. But pivot to scenario 2. The economy is currently running dangerously hot, plagued by exceptionally high inflation rates. To normalize the machine and stop the overheating, the central bank is forced to deploy contractionary policy. The first step is an active reversal. They turn the valve to severely shrink the total money supply. By strictly limiting cash in the system, the mathematical consequence is a sharp, immediate spike in interest rates. This creates a chilling effect on the ground. Expensive debt actively discourages businesses from expanding. It halts hiring and forces consumers to put away their wallets. It also creates collateral damage. Shifting the inflation dynamics makes domestic products less competitive abroad, actively hurting exporters. It is deliberate economic pain, but tightening the money supply is the only effective method to reduce aggregate demand and choke off runaway inflation. The national economy functions as a continuously managed machine, calibrated daily by authorities watching for the slightest deviation in performance. Central banks around the globe are constantly analyzing fresh employment and inflation data, calculating exactly which policy chain to trigger next. When financial headlines announce adjustments to reserve requirements or a subtle shift in the loan rate, it isn't arbitrary. Those maneuvers directly dictate the cost of your personal debt, the viability of your savings, and the likelihood of your company expanding. Ultimately, the hidden mechanics of monetary policy determine the speed and direction of a nation's entire economic trajectory. The total economic output of a modern nation can be precisely measured and understood as a single, massive mechanical system. Keynesian macroeconomics states the health of this system depends on a perfect mathematical balance. Balance begins with aggregate supply, an economy's total physical output of products and services. This meets aggregate demand, which is the total volume of spending for those goods. To maintain a stable baseline, these forces must act as yin and yang, matching precisely. This mathematical alignment serves as the primary benchmark for evaluating an economy's overall performance. In practice, this delicate mathematical equilibrium is incredibly difficult to sustain, and it remains constantly vulnerable to unexpected systemic disruptions. When aggregate demand drops below the level of supply, the resulting surplus can lead to reduced production and economic recession. If demand exceeds supply, the competition for limited goods drives prices up, triggering inflation. Institutions intervene in the market to prevent these systemic imbalances from spiraling. This intervention is carried out through two distinct control systems: fiscal policy and monetary policy. By deconstructing the components of aggregate demand, we see how these levers physically steer the economy. To see how policy works, we must first look at the mathematical components that make up total demand. Aggregate demand combines four parts. The largest is consumer spending for household purchases. Above is investment spending for business capital. Third is government spending on public services. Finally, net exports accounts for international trade. Policymakers apply tools to stimulate these specific blocks. These four pillars dictate how any economic policy actually translates into real-world growth. Monetary policy is the first lever, operated exclusively by a central bank. Its primary function is to influence economic activity by manipulating borrowing conditions. One expansionary tool is reducing national interest rates, lowering the cost of capital. This reduces the friction of borrowing, making it cheaper to access money. Lower rates encourage spending and investment, causing the consumer and investment blocks to expand. Central banks also engage in open market operations to further increase the money supply. Here, the central bank buys securities from the market, trading paper assets for liquid cash. This exchange injects immediate liquidity into the banking system, saturating the financial network. This increased supply of cash incentivizes banks to lend more, which further drives business and consumer spending. Monetary policy expands aggregate demand indirectly by changing the cost of capital to encourage private sector activity. The second lever is fiscal policy, operated directly by the government treasury. Unlike the central bank's indirect incentives, it involves direct intervention in the economy. The government can initiate expansion by reducing tax rates. Cutting taxes removes the financial burden on the private sector, meaning the economy retains more of its earnings. This immediate increase in disposable income allows businesses and consumers to spend and invest without the need for new loans. The second fiscal tool is the direct increase of government spending. This involves the direct purchase of public goods and infrastructure, flowing straight into the government spending block. This creates a ripple effect. The money spent becomes revenue for businesses and wages for workers, expanding the consumer and investment blocks. These direct injections of government capital typically impact the broader economy much faster than the gradual indirect adjustments of national interest rates. Fiscal policy expands aggregate demand by putting capital directly into the accounts of economic actors. Viewed as a whole, these interconnected systems of supply and demand operate together as a single, dynamic macroeconomic engine. In periods of slow growth, policymakers often employ both fiscal and monetary tools at the same time. This combined approach utilizes two different pipelines, direct treasury spending and indirect banking incentives, to target the same goal of expansion. These combined inputs drive the total metric of aggregate demand upward. This expansion temporarily tips the scale, as the new level of demand now outweighs the existing aggregate supply. This imbalance signals the economy to increase production. As factories and services scale up to meet the new demand, the system reaches a higher level of total output, re-establishing equilibrium. This production scaling directly correlates with higher national employment, as businesses hire to meet increased demand. These shifting policy conditions ultimately shape the spending and savings habits of every economic participant. Balancing these forces is the primary mechanism for managing growth while preventing runaway inflation. These policy levers provide the mechanical framework for regulating a nation's economic stability. Ultimately, the long-term trajectory of an economy is determined by the continuous, active calibration of this massive macroeconomic engine.